Sir, when I start learning investing, everywhere I hear about entry points, when to buy, how to buy, and at what price to enter, but it feels like nobody really talks about the exit, even though I think exit is where profit is actually decided and loss is finally locked. You are thinking in the right direction, because entry is only the starting point in investing. But exit is the moment where you actually lock your real result, and if your exit is wrong, then even the best entry becomes useless. That is why professionals treat exit even more seriously than entry. If I am in profit on an investment, but I am not clear about when exactly I should exit, should I just keep waiting for more profit, or should I already have a structured exit plan so that I don't lose my gains due to greed in the first place? Greed is one of the most dangerous emotions in investing because it distorts rational thinking. Markets do not move in one straight direction but in cycles. That is why a predefined exit plan is necessary. It keeps emotions under control and protects your profits. When I see profit on the screen, I feel like I should hold a little longer to earn more return. But sometimes the market suddenly reverses and my entire profit turns into a loss. So how do I control this emotional trap? This happens because of the conflict between greed and fear. When you invest without rules, your decisions become moment-based and risky. But when you set predefined targets, your mind stays stable, and regret automatically reduces because you are following a system, not emotions. If I am a long-term investor, should I ever exit at all, or should I just hold forever until the investment grows? Because many people say that buy and forget is the safest strategy. Long-term investing does not mean blind holding, it means disciplined holding. You need to review your investments over time, because fundamentals can change, businesses can weaken, and sometimes exiting becomes necessary for capital protection. When the market becomes highly volatile and prices keep going up and down continuously, how do I know whether it is normal fluctuation or a real signal that I should exit? Understanding volatility versus trend reversal is a critical skill. Short-term movements are normal, but long-term structural changes matter more. Making decisions only based on price is risky, so analysis and patience both are required. If I set exit targets for every investment in advance, will that make me a more disciplined investor, or do I still need flexibility based on market conditions so I don't miss opportunities? Predefined targets create discipline, but flexibility is equally important because markets are dynamic. Sometimes early exit is better, and sometimes holding longer is more profitable, so structured flexibility is the best approach. When people exit early and later the market goes higher, they regret it, and when they hold too long and the market falls, they also regret it. So how do I escape this regret cycle? Regret happens when decisions are emotion-based. But when you follow a system, the outcome becomes secondary and the process becomes primary. Rules-based investing reduces regret because you are not guessing. You are following a plan. Is exit strategy only a profit-booking tool, or does it also have a deeper role like capital protection and risk management that directly affects long-term wealth? Exit strategy is not just about selling, it is a core risk management tool. It protects your capital and secures your gains, because a wrong exit decision can turn profit into loss very quickly. When I distribute my money across multiple investments, how do I decide which asset to hold longer and which one to exit first so that my overall portfolio stays balanced? Every asset has a different role in a portfolio. Some are for growth and some are for stability. That is why their exit timing also differs. Periodic review and rebalancing are necessary for proper portfolio management. If I am in a losing position, should I exit immediately or wait for the market to recover, because not every loss is permanent? If the original investment thesis is still valid, then holding can be justified. But if fundamentals are broken, then exiting is the better option. Blind holding can increase losses, so situation analysis is very important. Is stop loss necessary for every investor, or does experience eventually replace the need for strict rules, because instincts improve over time? Stop loss is essential for beginners, and even with experience instincts improve, but professional investors still use risk management rules, so the best approach is a combination of system and experience. If the market suddenly crashes, Should I panic exit, or should I stay calm and wait for recovery, because crashes often recover later? Panic exit is one of the biggest mistakes in investing. During crashes you need calm analysis. If fundamentals are strong, recovery is possible, but if structure is broken, then exiting becomes necessary. Is partial exit better than full exit when the market is at a peak, or should I always completely exit to secure profit? Partial exit is usually a more balanced strategy because it secures profit while still allowing upside exposure. Full exit can sometimes lead to missed opportunities if the market continues rising. When I book profit, I sometimes feel guilty that I exited too early. How do I deal with this feeling? Guilt comes from unrealistic expectations. Because perfect timing does not exist in investing, you should focus on process rather than outcome and prioritize consistency over perfection. Is exit strategy different for different assets like stocks, crypto, and real estate, or do the same rules apply everywhere? Every asset class behaves differently, so exit strategies must also be customized. Volatility, liquidity, and market cycles all matter, so one universal rule does not work everywhere. If I keep exiting and re-entering frequently, will my returns improve, or will it reduce my overall performance due to unnecessary trading? Frequent trading usually increases costs and mistakes. Long-term holding often produces better results unless you have a strong strategy, so overtrading should generally be avoided. When I exit to protect profits, I sometimes feel like I might be missing future gains. So is profit protection always a trade-off with opportunity loss, or is there a way to balance both? Yes, both are natural trade-offs in investing. You cannot capture every move perfectly. That is why partial exits and scaling strategies are used to balance profit protection with future upside. Which is more dangerous, emotional exit or delayed exit when people hold too long due to greed? Both are dangerous, but delayed exit is usually more costly because it converts existing profit into loss. Emotional exit is a short-term mistake, but delayed exit causes structural damage. How do I know when the exit signal is actually coming? Should I rely on price action or some deeper analysis? Exit signals come from fundamental changes, trend reversals, and predefined targets. Price alone is not enough. Proper analysis is always required before making a decision. But do successful investors plan every exit in advance, or do they decide everything based on market conditions? Successful investors mostly plan in advance but remain flexible. They follow systems but are not rigid. Balance between planning and adaptability is their real strength. Is ignoring exit strategy one of the biggest mistakes in investing, or can it sometimes be acceptable? Ignoring exit strategy is one of the biggest mistakes because it removes risk control. Without exit planning, investing becomes gambling instead of structured investing. In a sideways market, should I exit or just hold until a clear trend appears? In sideways markets, patience is important. Unnecessary exits increase costs, but holding weak assets is also not wise, so selective decision-making is required. Is exit strategy based on time, profit, or market condition, or is it a combination of all? Exit strategy is usually a hybrid of all three. Time, profit targets, and market conditions all work together. Relying on only one factor is very risky. After exiting an investment, should I immediately reinvest or should I wait for the next opportunity? It depends on market conditions. If better opportunities exist, then reinvesting makes sense. Otherwise, holding cash is also a valid strategy. Is exit strategy more important for beginners, or is it equally important for experienced investors? Exit strategy is equally important for everyone. Beginners need it for protection, and experienced investors need it for optimization. Only execution level differs. When I understand everything, it feels like exit strategy is not just selling, but a complete financial discipline system where emotions are controlled, profits are protected, and wealth is stabilized. But I still want to know if this entire concept can be summarized into one powerful simple line that every investor should remember. The core rule of exit strategy is to follow your plan, not the market, because profits are only safe when they are locked with discipline. Emotions are the biggest risk factor, and structured decisions are what create long-term wealth. Boss, now I understand that exit strategy is a very important part of investing. But now I have another confusion that when I divide my money into multiple assets, how do I decide how much to invest in each one, and when should I adjust or rebalance my portfolio? This is the next level investing skill, where portfolio allocation and rebalancing completely change the game. In the next topic we will understand how to distribute your money properly and when to adjust it. And this is exactly what separates an average investor from a professional investor.